Midterm election years are historically the most volatile of the four-year presidential cycle for the stock market. Last week, we presented the C Fund, modeled by the S&P 500 index, and described how it had reached trend resistance. This area of potential resistance was defined by the rising trend line connecting the highs of December 2024, October 2025, and the 2026 highs. We were anticipating a pullback from this area of potential resistance, and so far, the market has responded as anticipated. As shown here, the S&P 500 is beginning to pull back, as highlighted by the red rectangle. In the lower window, the technical indicators are also showing signs of weakness. The Relative Strength Index, or RSI, reached the upper boundary of its trend resistance and is beginning to roll over. At the same time, the stochastics reached an overbought condition. Together, these indicators suggest that the market is increasingly vulnerable to a short-term pullback or consolidation. Now let's compare the current setup with the historical performance of the S&P 500 during U.S. midterm election years. The red rectangle shows approximately where the market currently stands within the historical midterm year pattern. While no two market cycles are identical, this seasonal pattern suggests that the market could very well decline from current levels. The magnitude of the decline varies considerably from year to year, but the historical average suggests a decline of roughly 2% into late September or early October. Remember, this chart goes all the way back to 1931, so the decline shown here represents an average. Individual midterm years can vary substantially. Going back to the current S&P 500 chart, trend support is represented by the rising red line. If the index were to pull back all the way to this trend support, that would equate to a potential decline of approximately 4% from current levels, which is more than the average 2% historical pullback. And we do not want to participate in that decline. Once that seasonal bottom has been reached, the S&P 500 has historically rallied approximately plus 7%, on average, through the end of the year. Again, this is simply an average based on historical performance. Now let's go back one more time to the current S&P 500 chart. We've hypothetically placed a bottom near the end of September and drawn an arrow from that area back toward the upper trend resistance line. Under this scenario, a move from approximately 7,400 to 8,200 would represent a gain of roughly 10% to 11%. The historical midterm year average is closer to 7%, so we're not suggesting that 8,200 is a specific price target. However, based on the current technical structure of the market, a move of approximately 11% from a potential late September low is certainly within the realm of possibility. At the moment, we currently have our members in protection mode. We'll continue watching the technical picture closely and make allocation adjustments as conditions warrant in the days and weeks ahead. If you like this video, please give it a thumbs up and subscribe to our TSP Fund Trading Analysis YouTube channel. With your continued support, we're working to grow the channel. Thank you for watching.